Welcome to the Taxing Subjects podcast brought to you by Drake Software. I'm Ryan Norton, and today we're going to discuss the new qualified business income deduction and how it affects pass-through entities like partnerships and S corporations. And today we're joined for that discussion by two representatives from Drake Software, Olena Romanchuk, CPA and tax analyst for Drake, and Bob Nolan, the lead tax analyst, CPA, EA. Welcome to the show, you two.
Nice to see you.
Thank you for having us.
Well, we have a little bit to cover today, and this is one of those topics that can be a little confusing for people, so we'll just jump into it. But Bob, I'm going to throw this one to you first. Could you briefly explain the Section 199 Cap A qualified business income deduction for those who may not be familiar with it? Why was it created? What does it do?
Well, the notion of it was to, because the C corporation tax rates have been reduced to 21%, why wouldn't a small business owner that has a Schedule C or a partnership or a Schedule F or what have you, benefit from a lower tax rate also? And this is the way that Congress chose to approach that.
How do they try to, so if they have a flat 21% tax rate for C Corps, what is the QBI?
Well, the small business owner is still going to be paying tax at his regular income tax rate, the personal tax rate. But the reduction of 20% of his business income has the same effect as essentially as having had a lower rate. You're paying tax on only 80% of the income. So even though you're still paying at the same rate, it's saving you some money.
Olena, what types of income qualify for the 20% deduction?
As we were talking before, first and foremost, income from the trade or business qualifies for this deduction. Also, income from publicly traded partnership, income from real estate investment trust, co-op dividends. So these items do qualify for this deduction.
Going back to what I said at the very beginning, I mentioned that QBI can be confusing to people. And in fact, the first memory I even have of it was sitting in a meeting and someone mentioned this will be a head scratcher for people. People might not feel as easy about performing the QBI calculation for the purposes of the deduction as opposed to, like, say, the flat 21% for the C corporation tax break. So, Bob, if you could, what is it about this deduction that is confusing for people?
It's one of those, devil is in the details things. There are a lot of points of confusion. When does rental income count as a qualified business income? When doesn't it? Why wouldn't it? Can activities, if, say, an S corporation is involved in more than one business activity, does it group them together and report it to the shareholder that way? The answer to that turned out to be no. Or does it, as the answer turned out to be, they have to break everything out separate by business activity? The grouping can only be done by the individual. What is a specified service business? When does the provision arise where the way it's stated in the statute is if the main asset of the business is an owner or employee's skills or reputation? Well, does that mean every auto repair shop is a specified service business? And fortunately, the regulations were pretty clear about that one and made it plain that for the most part, no, people are not going to be snared by that. But just a few examples.
One of the first things you mentioned was rental income, and the Reg 1078-92-18 does specifically say something about rental income, but it might not necessarily be as clear as someone who's looking for specific answers about rental income might hope it was. Olena, what does the reg say about rental income?
Well, it doesn't, like you said, specifically say, well, it's included in QBI or not. It just, basically, if the rental income rises to the definition of trade or business under Section 162, then it seems to be like it can qualify for QBI. That seems to be where the reg is heading, but as I said before, there's no clear answer to that. However, the regs do talk about self-rental, and for that purpose, rental activity is qualified for QBI. I do have actually what's written in there. So it says solely for purpose of Section 199A, the rental or leasing of tangible or intangible property to a related trade or business is treated as a trade or business if the rental or leasing and other trade or business are commonly controlled under proposed 199A-4B1I. So it does talk about self-rental, and that's the only clear-cut somewhat answer there.
So we're still waiting on a more definitive thing
They
from the
may
IRS. But
or may not be more the definitive thing, and it will be just case-by-case situation.
well, let's move on to some of the special rules that are outlined in the reg. I'll throw this one to either one of y'all. You can just kind of take individual points as you want. But what are some of the special rules that are outlined in the reg?
Well, I think I will start with pass-throughs, since we already touched on this issue. Regulations do discuss how to report to individuals who are shareholders or partners in a pass-through. And first of all, a pass-through will need to determine if it's involved in more than one trade or business. And if it does, like Bob said, they will need to allocate all of these items by trade or business, and only after that, those items will be allocated to shareholders or partners. And then you mentioned that it is a difficult section, and mainly I would think mainly because it's somewhat layered and income is pretty much separated. So you will need to look at the income that coming from a trade or business and do calculation there, and there are some limits there that can apply. And then you will need to look at separate type of income, which is coming from publicly traded partnership or rental real estate investment trust, and then you will look at that income and those losses and like group those together only at that level, and then you apply limits there, and then kind of like group them all together and look at the final answer. So there's a multi-step process there.
One
and
point.
Yeah, and because of that, you will need to report all of those items separately.
One point about that, I don't know how aware everybody is it stated in the regs that if the K-1 that's issued to the shareholder or the partner does not detail the items that qualify for qualified business income, they're to be treated as zero on the shareholder's return. So it's going to be very important if you're working on an S-corp or a partnership return to make sure that you have that detailed information and that it's included in some fashion on the K-1 that's issued.
Right, and I think it's especially important if different people file an S-corporation return and individual. So when you file an individual return and you don't file S-corp, you might need to go and ask, is there trade or business, is there QBI items, because I don't see it on the K-1.
Is there anything interesting about QBI that either of you think is not being really discussed right now? Something that might be, it's in here, but people might either not be paying attention to it or just not talking about it. And I'll throw the first one to you, Bob.
One thing that kind of catches my attention that I don't see much discussion of is the interaction between the Section 199A deduction with its limit for certain high income taxpayers. for 2.5% of your unadjusted basis in the assets that the business is using. If you have the de minimis election in place and you've been expensing items that were, under that $2,500 limit, well, you don't have those in your asset base. And instead of having potentially 10 years of being able to include their basis in that Section 199A calculation, for some people, you may want to consider that and what the arithmetic looks like and whether that de minimis election still makes sense.
What about you, Olena?
I think one of the interesting points was presumption of former employee. Basically, what that was saying, if you were performing the same services for a company and you were employee at that company and then you decided to leave and open your own business, but you still performing the same functions, and that those are the only functions you have, you will be considered as employee of that company, and that prevents people from forming their own businesses just to get this 199A deduction. For example, if Bob and I were working at the accounting firm and we were preparing certain tax returns, and then we decided to leave to get the 199A deduction and form our own S corporation or whatever, but still perform the same exact services to that former company, then we will be classified as employees still of that company, and we will get no deduction.
Do you believe, Olena, that this new QBI calculation will draw people from C corporations, despite the fact that they just get a flat 21%? Do you think that this calculation could end up advantaging certain people enough to make them want to reclassify their business as, say, an S corporation or a partnership?
It will depend on the client, so this is the time where you may want to reconsider the structure of the entity and perform an analysis and see, is it still beneficial to be an S corporation or a partnership, or is it more beneficial to be a C corporation now? Now, since the tax rate has been lowered for C corporation, it's a flat 21%, but it still has the double taxation, which we were trying to avoid previously. So we'll just need to see if 21% is more beneficial, or you can take the QBI deduction, it will be beneficial. And then we'll need to consider other provisions as well. There was a lot of changes in foreign provisions, and most of them do favor C corporations.
Well, I just want to thank both of you again for being here, Bob and Olena. It's always a pleasure to talk to both of you, and I know this is a complicated issue for a lot of people who are getting ready for going into next tax season. So thank you for being here.
Thanks for having us.
Thank you.
That'll be it for this episode. We'll see you all on the next Taxing Subjects podcast.